Why is BlackRock moving assets into sovereign debt illiquidity 2026? The global monetary architecture just quietly crossed a structural threshold that major financial media networks like CNBC, Bloomberg, and Reuters are failing to report on their morning broadcasts. While retail investors across the United States, the United Kingdom, Canada, Switzerland, and Australia were kept focused on public equity rallies throughout 2026, over $2.5 trillion in excess liquidity vanished from the Federal Reserve Bank of New York's overnight reverse repurchase agreement facility, plunging on RRP balances from their historical peak down toward critical operational baselines below $200 billion under Federal Reserve Chair Jerome Powell's watch. This is not a routine market consolidation or a seasonal liquidity drawdown. This is a systematic, institutional capital relocation led by shadow banking networks, primary dealers like JPMorgan Chase and Goldman Sachs, and sovereign wealth managers operating through non-bank financial intermediaries. To identify where this liquidity is accumulating, we must analyze the electronic paper trail generated by BlackRock CEO Larry Fink and his company's enterprise risk engine, Aladdin, which oversees more than $21 trillion in global assets under management. Cross-referencing Form 13F institutional disclosures and Form 10K filings submitted to SEC Chairman Gary Gensler at the U.S. Securities and Exchange Commission reveals an unmistakable pattern. Capital is evacuating traditional commercial bank deposit rails governed by the Federal Deposit Insurance Act and migrating directly into opaque, highly illiquid, asset-backed private credit and infrastructure structures. If you hold wealth inside G7 economies, the statutory framework governing systemic liquidity, bank bail-in provisions, and asset protection has been altered behind closed doors without a public vote. Continuing directly down this electronic paper trail, let us evaluate the raw financial telemetry published by the Federal Reserve Bank of St. Louis through its FRED database alongside official releases from General Manager Augustin Carstens at the Bank for International Settlements in Basel, Switzerland. Between late 2022 and mid-2026, the Fed's on RRP facility experienced an unprecedented cash drain as institutional money market funds redirected capital out of central bank facilities and into short-term treasury bills, commercial paper, and private liquidity pools. This multi-trillion-dollar liquidity outflow did not flow into commercial loan portfolios, consumer credit lines, residential mortgages, or corporate capital expenditure. Instead, analytical data from the BS and the Financial Stability Board under Chair Klaus Knott indicates a dramatic surge in private credit allocations, a shadow banking sector expanding past $3.5 trillion globally, alongside complex, off-balance sheet foreign exchange swap arrangements. Asset managers including BlackRock, Vanguard CEO Salim Ramji, State Street Chairman Ronald O'Hanley, and Brookfield Asset Management CEO Bruce Flatt are executing a coordinated allocation shift. By utilizing private debt vehicles, business development companies, and asset-backed finance structures, these mega-managers are acquiring tangible infrastructure, such as municipal energy grids, commercial port terminals in Rotterdam, Singapore, and Hamburg, and high-density AI data center facilities at severe valuation discounts. They are converting vulnerable fiat claims into perpetual physical monopolies while insulating their yields through non-bank financial structures that bypass standard FDIC insurance limits under the Federal Deposit Insurance Corporation, European Central Bank reserve mandates under President Christine Lagarde, and traditional Basel III bank capital adequacy frameworks. Expanding on these institutional asset acquisitions, we must look beyond Wall Street and examine the offshore legal channels that route global liquidity across international borders. Cross-referencing database records from Executive Director Gerard Riles' team at the International Consortium of Investigative Journalists and Open Corporates uncovers an intricate multi-jurisdictional web. Liquidity originating from major financial centers in Manhattan, the City of London, and Tokyo flows directly into special-purpose vehicles, exempted limited partnerships, and segregated portfolio companies registered under Managing Director Cindy Scotland at the Cayman Islands Monetary Authority, before settling into institutional private banking terminals across Zurich, Geneva, Luxembourg, Liechtenstein, and Singapore. This institutional design relies on statutory asset protection mechanisms designed to shield balance sheets during systemic debt restructuring events. By holding assets through tiered corporate structures across tax-neutral jurisdictions like the British Virgin Islands, Jersey, and Guernsey, multi-billion-dollar private funds isolate their capital from rising sovereign debt yields, structural fiscal deficits, and potential bank bail-in resolutions under Title II of the Dodd-Frank Wall Street Reform and Consumer Protection Act, or the European Union's Bank Recovery and Resolution Directive. While sovereign G7 bond yields experience heightened volatility and currency purchasing power erodes through continuous fiscal monetization, global funds secure senior secured debt positions, priority lien holdings, and inflation-indexed cash flows that operate entirely outside standard commercial banking channels. When you synthesize these regulatory filings, liquidity flows, and cross-border structural movements, the macroeconomic paradigm shift becomes completely transparent. While retail market participants remain distracted by daily volatility metrics across the S&P 500, NASDAQ 100, and retail brokerage platforms, institutional sovereign allocators are quietly finalizing a fundamental balance sheet restructuring designed for multi-generational capital preservation. Consider the strategic stance executed by Chief Executive Officer Nicolai Tangen at Norway's $1.6 trillion government pension fund Global, or Governor Yasser Al-Rumayyan directing Saudi Arabia's Public Investment Fund. These sovereign entities are deliberately systematically mitigating counterparty and sovereign currency risks by reducing unhedged fiat currency reserves and long-duration G7 government bonds. Instead, elite global capital is being deployed into senior floating-rate private debt, critical energy transportation corridors, telecom node infrastructure, and multi-jurisdictional private trust arrangements constructed to endure sovereign debt realignments, currency debasement cycles, and statutory bail-in interventions. For family offices, institutional treasurers, and sophisticated global allocators navigating the complex economic environment of 2026, preserving institutional purchasing power requires transcending conventional retail narratives and adopting the operational sophistication of non-bank liquidity providers. By continuously monitoring central bank balance sheet telemetry, tracking shadow banking capital migration across international clearing networks, and establishing structural legal insulation, long-term capital remains sovereign, resilient, and fully protected against broader systemic instability. Thanks for analyzing this executive intelligence briefing on Zillionaire Circle. If this research provided actionable value for your capital management strategy, subscribe to the channel, select the notification bell, and join the strategic discourse in the comments below. We will analyze specific cross-border trust structures in our upcoming institutional liquidity brief.